Right now, the silver market is splitting into two separate dimensions. While the numbers on your screen tell one story, the streets of Tokyo are telling another entirely. Verified reports from the Japanese retail market show physical silver bars trading for the equivalent of $130 per ounce. That is an 83% premium over the Western spot price. The cable linking paper contracts to physical metal hasn't just frayed, it's been severed. We are currently sitting in the middle of a ghost week liquidity trap, facing a structural deficit that has been building for 7 years and a global supply chain that just changed forever. Is this the final breakout, or the mother of all drive-by shootings by the big banks? Today, silver is currently flashing $73.97 per ounce on the exchanges. But to understand why this number is so volatile, we have to look at the three powder keg factors currently driving the price. 1. The ghost week. Liquidity trap. We are currently in a 10-day liquidity blackout where major market makers are on vacation until January 6th. Trading volume has dropped by roughly 70%, leaving the market in the hands of automated algorithms and skeleton crews. This creates a vacuum where even small buy orders can cause massive gaps in price. 2. The China export ban. Just yesterday, on January 1st, China implemented strict new export regulations. This is being viewed by analysts as a soft ban, as licenses are now only granted to state-owned refiners. China consumes over 6,000 tons of silver annually, but only produces 3,500, and they are now prioritizing their own solar and EV industries over Western exports. 3. The structural deficit. Silver has now been in a supply deficit for 7 consecutive years. Global mine production has remained flat at around 800 million ounces for the last 5 years because it takes an average of 6.5 years to bring a new mine online. Why are individuals and institutions suddenly scrambling for silver? It's no longer just a pet. Rocket has transitioned into a strategic industrial commodity. Inelastic industrial demand. The technology shift to TOPCon solar cells requires 50% more silver per panel than older tech. Similarly, the US government officially designated silver as a critical mineral in 2025 because it is essential for everything from AI data centers to smart bombs and fighter jets demand that is often off the books. Institutional inflow. For years, institutional funds held almost zero silver. Now, giants like Morgan Stanley and Bank of America are reportedly advising clients to move away from the traditional 60/40th portfolio toward holding 20% to 25% in gold and silver, the melting ice cube dollar, with the Federal Reserve expected to continue quantitative easing and money printing. Many investors view silver as a way to preserve purchasing power against a currency that feels like a melting ice cube. However, silver is not a buy and hold forever asset for everyone. It is vital to have an exit strategy. And here are the indicators. The sources suggest watching. 1. The gold to silver ratio. This remains the primary indicator for unloading positions. While it is currently elevated at 75, many investors look for a drop to 30 to 1 or even the historical 15 to 1 before selling. 2. Portfolio rebalancing and psychological fatigue. The banks often engineer flash crashes, what some call a drive-by shooting, to trigger stop losses and shake out weak hands. If the volatility becomes too high or the price hits a predetermined triple-digit target like $100 or $120, it may be time to take profits and 3. Regulatory exchange changes. Be wary of the exchanges. As prices climb, the COMEX may double or triple margin requirements to force smaller traders to liquidate. If the rules of the game change overnight, it might be safer to step aside. To wrap this up, think of the silver market like a powder keg where the fuse is already lit. The supply deficit is the gunpowder. The China export ban is the spark, and Ghost Week is the lack of a fire extinguisher. We are watching a controlled demolition of short positions by major banks who are trying to switch from being shorts to being the biggest bulls in the room. Before you make any moves, remember, I am drawing on market transcripts and historical data to educate, not to recommend. Precious metals are notoriously volatile. We have seen 4.5 sigma moves that only happened once every 240,000 days. Are you holding for triple digits? Or are you waiting for the January 6th liquidity return to see if this move is real? Let me know in the comments. Hit that like button. and subscribe for more deep dives into the mechanics of the physical silver squeeze. Thanks for watching.